There is a sentence I have carried with me throughout nearly 4 decades in financial markets. The market does not reward certainty, it rewards disciplined skepticism. I began working in finance in 1987. That date matters, because 1987 was the year the stock market fell by almost 25% in a single day. When you witness something like that early in your career, it changes the way you think about prediction. You become suspicious of anyone who claims that markets are simple, orderly, or reliably forecastable. And yet, despite that suspicion, I have always been fascinated by one question. Can markets be predicted? Not perfectly, of course, but even imperfect prediction can be extraordinarily valuable. A small, persistent advantage can become significant when applied repeatedly and with discipline. So, like many people in finance, I spent years studying patterns. I read economic research, I examined investor psychology, I looked at price history, volatility, sentiment, interest rates, elections, seasonal effects, and the relationship between public information and market behavior. I believed I was approaching markets scientifically. Then, about a year ago, I encountered something that sent me down a completely unexpected rabbit hole. I found an article about financial astrology. Yes, astrology. The article claimed that planetary movements could help forecast financial markets. It discussed Mercury retrograde, lunar phases, and astronomical cycles as though they were legitimate economic variables. My initial reaction was dismissal. I thought, this will take me a few days to disprove. I would collect some data, run a few tests, and demonstrate that astrology had no predictive power. Then I would move on. But the deeper I looked, the stranger the subject became. I found academic papers investigating lunar cycles and stock returns. I found financial professionals who had studied astrology seriously. I found historical strategies based on magazine covers, football games, clothing fashions, presidential elections, holidays, and even the nationality of the model appearing on the cover of the Sports Illustrated swimsuit issue. Some of these claims were obviously ridiculous. Others were more sophisticated, and a few appeared, at first glance, to have statistical support. That was the beginning of my book, Market Myths and Mathematical Realities. What interested me was not merely whether these indicators worked. The more important question was, why do intelligent people believe them? Human beings are extraordinary pattern recognition machines. That ability helped our ancestors survive. If you heard movement in the grass, it was safer to assume that a predator was hiding there than to dismiss the sound as random noise. Our brains evolved to detect patterns quickly, sometimes before we had complete evidence. That instinct is enormously useful in daily life. But in financial markets, it can become dangerous. Markets generate an almost unlimited amount of data. Every day, prices rise and fall, interest rates change, companies report earnings, politicians make speeches, sporting events occur. Seasons change, planets move, magazines publish new covers. With so many possible variables, coincidences are mathematically inevitable. Suppose I test 100 completely meaningless market indicators at the conventional 5% significance level. Even if none of those indicators has genuine predictive power, I should expect approximately 5 of them to appear statistically significant purely by chance. Now imagine testing not 100 possibilities, but thousands, perhaps millions. Eventually, I will discover something that looks remarkable. I might find that the market performs unusually well after a particular football team wins, or that returns are stronger during certain lunar phases, or that stock prices decline when Mercury appears to move backward through the night sky. Once I discover such a relationship, I can create a compelling story to explain it. And that story is often more persuasive than the statistics. Consider the Super Bowl indicator. The traditional claim is that the outcome of the Super Bowl predicts whether the stock market will rise or fall during the year. When the indicator was first popularized, it had an apparently extraordinary record. For a period, its predictions seemed almost perfect. But there was no economic mechanism connecting the identity of a football champion with corporate profits, interest rates, productivity, or investor cash flows. The relationship was coincidental. The indicator survived because it was memorable. People remembered the successful predictions and forgot the failures. Financial journalists enjoyed writing about it. The story was entertaining, and entertainment travels faster than statistical caution. This is an important lesson. An indicator does not become valid simply because it has predicted the past accurately. We must ask how it was discovered. Was the rule defined before the data were examined, or was it selected after searching through hundreds of possible relationships? That distinction separates genuine testing from data mining. If I choose an indicator after observing its historical success, the same data cannot provide an independent test of that indicator. The past has already influenced the rule. The real test begins afterward. Does the pattern continue when new data arrive? In most cases, it does not. The Super Bowl indicator is a relatively harmless example. Very few institutional investors would build a serious portfolio around the outcome of a football game. Other indicators are more dangerous because they sound technical. The Hindenburg Omen, for example, is a complex market-bred signal intended to warn of major stock market declines. It uses combinations of new highs, new lows, market trends, and other conditions. Because the formula is complicated, it appears scientific. But complexity should never be confused with validity. A complicated indicator can fail for exactly the same reasons as a simple superstition. It may generate many false alarms. Its historical definition may change. Analysts may disagree about which signals count. A successful warning may be celebrated, while unsuccessful warnings quietly disappear from memory. This creates what I call the sophistication illusion. People often assume that a complex formula must contain more information than a simple one. In reality, complexity gives researchers more freedom to adjust parameters until the historical results look attractive. The more adjustable elements a model contains, the easier it becomes to fit noise. That is why I evaluate every indicator using the same basic questions. First, does it beat the relevant baseline? If the stock market rises in roughly 7 out of 10 years, an indicator that predicts up 7 out of 10 times may contain no information at all. It may simply be benefiting from the market's natural upward tendency. Second, is there a plausible mechanism? Correlation alone is not enough. I want to understand how the indicator could influence economic behavior, investor decisions, cash flows, or risk premiums. Third, does it work outside the period in which it was discovered? That can mean a later time period, a different country, another asset class, or a genuinely reserved sample that was not used during development. Fourth, does the effect survive real-world implementation? A statistically significant pattern may be economically useless after transaction costs, taxes, bid-ask spreads, market impact, and time spent out of the market. This distinction between statistical significance and economic significance is one of the most important ideas in the book. A result can be statistically real but financially irrelevant. Imagine discovering that the trading strategy earns an additional 20 basis points per year. With enough observations, that difference might be statistically significant. But if implementing the strategy costs 40 basis points, the strategy destroys value. The mathematics may be correct, while the investment conclusion is wrong. Calendar effects provide some of the most interesting examples because they often begin with a genuine market pattern. The January effect is one of them. Historically, small company stocks tended to perform unusually well in January. Unlike astrology or football indicators, the January effect had plausible explanations. Investors sometimes sold losing stocks near year-end to realize tax losses. Portfolio managers adjusted holdings before annual reporting dates. After the new year began, some of that selling pressure reversed. For a time, the effect appeared meaningful. But markets adapt. Once a pattern becomes widely known, traders can anticipate it. Tax rules change, trading costs decline, institutional behavior evolves, investors act earlier. As a result, many once profitable calendar effects weaken after publication. This is a recurring feature of finance. In physics, discovering a natural law does not normally destroy the law. Publishing the formula for gravity does not cause gravity to disappear. Markets are different because market participants respond to discoveries. If researchers identify a predictable price pattern, investors attempt to exploit it. Their trading changes prices, often reducing or eliminating the opportunity. Markets are adaptive systems. The observer becomes part of the system being observed. That is one reason past performance must be treated cautiously. A historical pattern may have been real and yet no longer be profitable. The day of the week effect offers another example. For many years, researchers observed unusually weak returns on Mondays. Several explanations were proposed: settlement procedures, weakened information accumulation, investor mood, and institutional trading behavior. But as market structure changed, the effect weakened. Electronic trading expanded. Settlement cycles shortened. International market integration increased. Information moved continuously rather than waiting for Monday morning. The lesson is not that the original research was necessarily fraudulent. The lesson is that market relationships are conditional. They depend on institutions, regulations, technology, investor behavior, and the historical period being studied. A pattern is not a permanent law merely because it once appeared in the data. Now we come to the indicator that produced the most complicated conclusion in my research, the Halloween effect, better known as sell in May and go away. The traditional claim is that stock market returns from November through April are substantially stronger than returns from May through October. This pattern is unusual because it has appeared across many countries and long historical periods. It has also survived more independent investigation than most market folklore. Among the indicators I examined, it had the strongest surviving evidence. But that does not mean an investor can simply sell every May, return every November, and become rich. The existence of a seasonal return difference is not the same as the existence of an easily captured trading profit. During the weaker summer period, investors must place their money somewhere. Cash and bonds produce different returns in different interest rate environments. Leaving the equity market may also create tax consequences. Trading dates matter, transaction costs matter, risk exposure matters. Buy and hold investors receive the full long-term equity premium. A seasonal investor may reduce drawdowns, but may also miss sudden rallies. So my conclusion is deliberately cautious. The Halloween effect appears to represent a persistent seasonal return differential. It is stronger than the other indicators in the book. But it is not a guaranteed source of after-tax alpha. Its value may lie more in risk allocation and portfolio timing than in a mechanical all-in, all-out strategy. This distinction matters because investors naturally want simple answers. Does it work or not? Should I trade it or not? But markets rarely offer clean binary conclusions. A pattern can be statistically credible yet difficult to exploit. It can improve risk-adjusted returns for one investor and reduce after-tax wealth for another. It can work in one implementation and fail in another. Good quantitative analysis does not eliminate uncertainty. It measures uncertainty and prevents us from pretending that it does not exist. The deeper theme of my book is not really astrology, calendar effects, football games, or magazine covers. It is belief. Why do market myths persist even after evidence contradicts them? One reason is confirmation bias. We remember successful predictions more vividly than failures. If an astrologer warns of a market crash and the market falls, that prediction may be repeated for years. If the market rises instead, the forecast is forgotten or reinterpreted. Another reason is the narrative fallacy. Human beings prefer coherent stories to probability distributions. Stocks fell because investors feared recession feels more satisfying than stocks fell because millions of participants traded for different and sometimes contradictory reasons. Financial news often creates explanations after prices move. When markets rise, journalists find optimistic reasons. When markets fall, they find pessimistic reasons. These explanations may be plausible, but plausibility after the event is not the same as predictive power before it. There is also publication bias. Research showing a surprising effect is more likely to be published than research finding nothing. A paper entitled "The Moon Predicts Stock Returns" attracts attention. A paper entitled "We tested 47 astronomical variables and found no reliable relationship" is less exciting. As a result, the published literature may contain more positive results than reality justifies. The unsuccessful tests remain hidden in file drawers. Financial incentives reinforce this problem. There is little commercial value in telling investors that prediction is difficult. There is considerable value in selling a formula, newsletter, model, indicator, or secret system. Certainty is marketable. Humility is not. But humility is one of the most valuable qualities an investor can possess. Humility does not mean refusing to make decisions. Investors must act despite uncertainty. Humility means recognizing the difference between evidence and confidence. It means understanding that a successful result may contain luck. It means asking what would cause us to change our minds. It means testing our own preferred theories as aggressively as we test the theories of other people. The scientific approach is not to prove ourselves right. It is to give reality an opportunity to prove us wrong. That is why the null hypothesis is so important. When I evaluate an indicator, I begin by assuming it has no predictive power. The burden of proof belongs to the indicator. I ask whether its historical success could reasonably have occurred by chance. I examine alternative definitions. I test different periods. I consider the number of hypotheses that may have been investigated. I look for independent replication. And even when the evidence survives, I ask whether the effect is large enough to matter. This process is less exciting than discovering a magical market signal, but it is far more useful. After nearly 40 years in finance, I do not believe the most successful investors possess supernatural forecasting abilities. I believe they are better at managing uncertainty. They control risk, they diversify, they avoid strategies that depend on one fragile assumption. They distinguish between what they know, what they suspect, and what they merely hope. They understand that being correct for the wrong reason can be more dangerous than being temporarily wrong for the right reason. Most importantly, they recognize luck. Financial markets contain enormous amounts of randomness. A poor strategy can succeed for years. A sound strategy can suffer long periods of disappointing performance. We cannot judge quality from outcomes alone. We must evaluate the process that produced those outcomes. Was the decision based on information available at the time? Was the risk understood? Was the strategy robust to alternative assumptions? Could the result be replicated? Would the investor make the same decision again under similar conditions? These questions are harder than asking whether an indicator went up or down, but they lead to better judgment. The goal of market myths and mathematical realities is not to provide a list of indicators you should never use. New indicators will always appear. Tomorrow's myths may involve artificial intelligence, social media sentiment, satellite images, alternative data, or variables we have not yet imagined. The specific myths will change. the psychological vulnerabilities will remain. Your real protection is not memorizing which historical indicators failed. It is developing a repeatable framework for evaluating any claim. Ask what the baseline is. Ask whether the rule was chosen before or after observing the data. Ask how many other rules were tested. Ask whether there is a plausible mechanism. Ask whether the result survives independent replication. Ask whether the profit survives costs, taxes, and risk adjustment. And ask the most uncomfortable question of all. What evidence would convince me that I am wrong? If the answer is nothing, then you do not have an investment thesis. You have a belief system. When I started investigating financial astrology, I expected to write a quick rebuttal. Instead, I spent a year studying the boundary between pattern and randomness, science and storytelling, genuine anomalies and statistical illusions. The journey made me more skeptical, but it also made me more open-minded. Skepticism does not mean rejecting every unusual idea. It means applying the same standards to unusual ideas that we apply to conventional ones. Occasionally, a strange claim survives serious testing. Most do not. The important thing is that our conclusions follow the evidence rather than our preferences. Markets will always tempt us with certainty. There will always be someone offering a perfect indicator, a secret cycle, a guaranteed forecast, or an explanation that makes the chaos appear orderly. The better response is quieter. Read skeptically, test rigorously, trade cautiously. And remember that markets reward humility far more generously than they reward certainty. I'm Luigi Pascal Rondanini, author of Market Myths and Mathematical Realities, and you've been listening to Between the Covers and Beyond. Thank you for joining me.